Hi everyone. Weekly advisor movements for the week ending 11 June. Today's the 12th of June. This is our third edition now, so hopefully we'll get smoother. But firstly, a shout out to my team of data administrators, developers, data scientists, and the like, who actually pull this data together for me day in, day out from our database and clean up our database, clean up the financial advice register. So for me, they make it very, very easy. Before I move on to advisor movements, though, I just want to touch on the week that was. 5 key developments that I saw this week. Obviously, FPA's new blueprint for advice is one of those. Despite the jostling between the licensees and the FPA, obviously there was a lot more to it than self-licensing, and I think this morning, John Woolley came out in Professional Planner to say, let's put our swords down and focus on what's good for the entire industry. And I tend to agree with him there because there are some good things that the FPA has put forward. That is tax deductibility, continuing that fight. The second one is around professional indemnity insurance. So both of those have the ability to reduce the cost for advice for consumers. And so we're supportive of both of those initiatives. Unfortunately, though, the FASIA exam is still caught up in the Senate. Rex Patrick, the South Australian senator, is using it as a little bit of a political football at the moment by trying to amend the current bill and latch on corporate transparency for the rich listers onto that bill. And unfortunately, FASIA, it means the exam deadline is still floating around out there. Given 16,000 advisors need to still sit the exam, we think, or it should be sensible, that the Senate does pass this in the near future. Numbers 3 and 4, I'm going to combine. Climb Asset Management, run by Rod Bristow, bought up Madison in the last week or so. It has 97 advisors. As you may or may not know, Madison was bought by OneView following the liquidation of Sargon Capital. So OneView in itself, now that it managed to divest Madison, given it didn't want to own a licensee, was on the chopping block as well, unbeknownst to probably everybody, but it's looking to be sold to Iris, the Andrew Walsh-run Iris, for $107 million, subject to shareholder approval. I think we'll see a lot of this consolidation happening over the next few months, especially as COVID-19 starts to bear down on businesses, margins come under pressure, and continued consolidation, especially from the likes of KKR coming out from the US, big private equity firms, Japanese buyouts and the like. And finally, and sadly, $1.3 billion was withdrawn. APRA released its latest results for the week. So the week ending 31 May, a further $1.3 billion as part of early access to super. As we know, some of that's unfortunately going to end up in the coffers of the TAB and Sportsbet, based on the work that Ilion had already done. It's the second largest category in terms of where that money is going. But on to advisor movements. Who left the industry this month? Well, it was a lot less than last month's 170 by virtue of the fact we flushed out all of ANZ's advisors who moved either into a separate licensees and or left the industry. So 62 left. Again, that's more by virtue of the fact we're still flushing out My Planner, the suspension around that business. Switch licensees, we had 36, again lower than the previous run rates, more by virtue of the fact I think there's more due diligence going on at the moment for incoming advisors, and also due to the impact of businesses not being able to do much during COVID-19 and doing a lot of the due diligence and meeting face to face. Again, sadly, no one joined the industry. Now, that's going to be the case for a little longer as we feed through for the PY year. and graduates start to come through the system. And I don't think we'll start to see that number pick up until at least late 2021. Now, as I do, like I've done the last couple of times, a shout out to a few of those switches. Nathan Green left the Angus Benbow-owned professional investment services to the boutique WA-owned Badge Financial Group, a group that was only just set up, a licensee that was only just set up in December. Dishner left the MLC-owned or Garvin licensee owned by MLC to join Affinia, run by Marcus O'Sullivan. And Gordon Black, a 40-year veteran in the industry. Good to see Gordon still hanging around despite my planner's suspension. So Gordon moved to Lifestyle Asset Management and continues on his way there. Top gains for the month of Havana. Havana are picking up the My Planner advisors, so 11 joined this month. AAN Wealth, run by Noel Shepherd there, picked up 4. Alliance Wealth, again, part of the Centrepoint Alliance group, run by Angus Benbow, picked up 3. Eugene Ardino's group Lifespan picked up 3, and the Melbourne run and owned by Gary Kroll, Interprac, Sequoia, picked up 4, but lost 1 for the month as well. Here we see the top losses. As I said, the suspension of My Planner filtering through, 36 advisors left. AMP and MLC continue to consolidate their licenses. As you know, MLC announced the fact that they're calling their new group of employed advisors under Garvin, Godfrey Pembroke and the like, 1050. So that's the new name going forward. A couple of newbies here, Market Ag and Cambridge. Market Ag is actually an agricultural commodity advice group around pricing and marketing. So that's for producers and consumers. So they lost 5. And the global payment company, Cambridge, who look at currency fluctuations and help businesses with currency and consumers with currency fluctuations, high net worths, and currency hedging, lost 5 advisors. So what does that mean for the industry? Last week, that number in the middle was 22,307. Today, it's 22,245. So a net loss, as we said, of 62 advisors. Now, what we have done is refine the December 2021 number down by about 1,000 advisors. And our reasons for that that have played out in the last couple of weeks, obviously the run rate continues to be quite steady. So if we play that out just as it is at the moment, we do expect to see 12,000 advisors lost from the industry from its peak. That being 43%. Now, that's by virtue of the fact for several reasons. Obviously, the failure rates are coming through from the latest reset of the exam. We do expect higher pass rates for the initial tests. Those who are more confident tend to sit the exam first, and that shows in other industries. We're also seeing failure rates on second resets, which isn't great. So I think that's going to be a cause for concern. Once FASIA exam gets passed through the Senate, the number of advisors that will have to reset. 16,000 do have to reset, and of those, the average age of those advisors is older than the average that have sat already, based on the sampling that we have done. So, you know, these advisors who for 20, 30 years haven't sat an exam, obviously it's an anxious time for them. There's, you know, I think some of us read social media, and that causes further anxiety for some of these advisors. So I think we'll continue to see exits between now and December 2021. Advisor ratings ourselves, we run qual and quant data regularly, and we look at external survey data, money management, IFA, professional planner, all those publications, core data, investment trends, do put out data ongoing around this, as do we. And, you know, it does make for sobering reading, the fact that how many advisors do want to exit the industry, and we can confirm that that number is not abating. So that's that's us for the week. Join us next week and we'll have a rundown further in for June 2021. Thank you.